shouldn't know. I got secrets.
Hey there, Stephanie Kemmerman, the Stock Whisperer, here with this week's Dark Pool Insights for May 31st. I want to wish everybody a happy Memorial Day weekend. God bless our veterans, our military. I decided to take a little mini vacation this weekend. So I wasn't able to do trade setups for you guys, but I wanted to do a very special insights for you. I didn't want you to miss out on any education. I've had a lot of requests from so many of you to teach more about trading options, because these are, for me, the lowest risk, highest reward swing trades that you can do. So many times I know you've seen me post the trades that I take in the Java Pit trading room, but a lot of you wanted to learn a little bit more, especially the spread trades. Yeah, so that's what we're going to cover today. I'm so excited. I'm going to be walking you through so many trades that I've recently done and teaching you all the way through it. So I'm going to keep it simple. I'm going to be honest, I'm not going into great detail on all the Greeks and all that stuff. I'm really going to keep it simple and show you how to use the Dark Pool Insight trades using options. Yeah, how I do it. So let's start with timing. It's everything. It is. When trading options, timing really is everything, because they're kind of like ice cubes. If you take an ice cube out of the freezer, it starts to immediately melt. Directional option trades is like an ice cube melting right on your counter. I know you guys know what I'm talking about, right? They decay. Yeah, every minute that goes by, they are decaying. And I'm talking about directional option trades, calls and puts. In fact, check out this little slide here. And this is really cool. You can see 90 days out, doesn't really budge. 60 days till expiration, it starts to move. 30 days, look at that. Huge change right there. And very fast time decay with less than 30 days. But I have ways to combat that, which I'm going to show you in a little bit. So when picking an options trade, we have two major decisions to make. The first one is the strike, choosing a strike. The strike price of an option is the price at which a put or call option can be exercised. It's also known as the exercise price. So picking the strike price is one of the major decisions you have to make. So are we going to pick a strike that's in the money, at the money, or out of the money? So in this example right here of silver, this is the option chain. The calls are to the left and the puts are to the right. Here are all the strikes that we can choose from. So if you pick a 25.50 call option, and silver is, as you can see, the chart to the left is pretty much right there at 25, it's actually 53, right? These would be at the money. They're pretty much right where the price of the stock is. Keep in mind, if it expires at the money, if silver, by the time your option is expiring, in this case, this is June 4th right here. If silver closes at 25.50 or above 25.50, they can give you the stock. That's right. If you have one contract, all of a sudden you'll have 100 shares of stock in your account if you have money to cover it. If you don't have the money to buy the stock, they're not going to just give you stock. So keep that in mind. I like to get out way before expiration when I'm trading personally, right? Because remember, right, as we get close to expiration, your options are going to decay. So I try to get out way before that. So if we were to pick these 25 calls, that would be in the money because it's lower than where silver is trading at the time. And notice the price of those are $86 a contract. See the 86 cents? Where the 25.50s are less. They're 57 cents. But check these out. These 26 calls, these are out of the money because silver is at 25.53, right? And now we're buying these 26 calls. So we're projecting that silver is going to move up when we buy out of the money calls. Now most people, most traders, right? If you've ever taken an options workshop anywhere, they pretty much never tell you to buy out of the money options. Oh, no, they never do. It's like taboo, but they don't have the edge that we have, right? They're not following the dark pool. They don't know that a big move is about to happen on the stock, which means the options are going to explode. So this is why I like to buy out of the money options, because they're cheaper. And guess what? If the trade doesn't work out, I'm only risking $37 instead of $86 a contract. And each contract is equivalent to 100 shares of stock, by the way. So we can buy these out of the money options that are a lot cheaper, but keep in mind, look at this time decay chart, okay? See the in the money versus at the money. Notice they don't even put out of the money because they don't think that too many people are going to be trading them, but it's all I trade. Yeah, but look at the at the money. So even if the price of the stock is right by your strike price, it is still going to decay. Okay, another reason why I get out way before it expires. So I know many of you may not know this, but this is so cool. The highest return on investment happens with options when they go from out of the money to at the money. So if I bought those 26 calls on silver and silver went up to 26, I'm out. I am so out right there when we hit 26. That is the highest ROI I can get. It's hit my mark and I'm done. A lot of times I will roll my options. I'll just buy a new contract. And I'll show you that in a little bit. But, there's such amazing ROI on these options. And again, I'm buying them cheap. My favorite price on options are anywhere from 10 cents to 40 cents. That's $10 to $40 a contract. And if I'm on the right side of the dark pool, right side of the prints, right side of the trade, we can easily make 50 to 100% ROI pretty quickly. There are a lot of times that my traders and I have made, oh my gosh, 200 to 500% ROI. But guess what? If my trade doesn't work out, okay, I can only lose my initial investment. That's it. I'm not going to lose more than the $10, or if they're 40 cents, the 40 bucks. Now, the most popular reason that these trades may not work out is, you've guessed it, we run out of time, like I showed you that decay chart. Yeah, it's awful. When I learned this really the hard way when I started trading options. I had everything right. Okay, I knew the dark pool was buying, but my expirations, my options expired before the move happened. Or like right on that Friday, all of a sudden the stock started moving, but it was too late because, as I showed you, we decay. That ice cube is almost melted. So options have options. Yes, we have so many options. Okay, so the first thing I taught you is, we have to pick our strike price, and I like to go out of the money. The next thing we have to choose is the expiration. So right here are all the different expirations for silver. They have weekly options and they have monthly options. Monthly options have the most liquidity, so the most volume. The most people out there are trading monthlies. It's easier to get in and out. So when I have about 2, 3, or even 4 weeks, right until the next month, I love trading those. Yeah, If 3 weeks out and it's a monthly expiration, for me, that's my sweet spot. Really depends what we're trading. So, you know, look, my crystal ball is not perfect, okay? So I try to buy extra time, and time costs money. Let me show you. So here's the May 28th expiration for silver, the 26 calls, okay? These guys are 21 cents. Here's the option, right? These are expiring really soon, by the way. Yep. And you can see, you know, at the money going down the hill. But look at June 4th. Now we have a whole extra week here. And these guys are $37. So you can see you're paying for time. Time is money. And you always want to pay for a little more time. But again, we don't want to buy too expensive options, right? Because what if, I don't know, what if we get splashed? You guys know about the splash, right? Real-time dark pool prints create big splashes. You know, and I always try to teach all my traders to trade yesterday's prints or last week's prints. Most of the time, the splash is in the opposite direction, right, of the true intended move. In other words, they're going to fake you out in the wrong direction. And even if we wait patiently, there's still a chance we could be in the splash, right? So why risk a lot ever? That's how I feel. I could be caught in the splash, especially if I'm entering close to the print, like a print happened 2 days ago, 3 days ago. Yeah, once a little bit more time goes by, we could be a little bit more confident that we're in the right direction. And I know a lot of you know what I'm talking about, right? So I never freak out because my options are always really cheap. But if we go out too far with the options, they can be too pricey. Yeah. So check these out. These options highlighted in green. 26 calls, right? The 27 calls. These are going out to June 18th, are 40 cents. 26 calls are 68 cents. You see, these are pretty pricey. However, okay, here's the same option chain. If we were to buy the 26 calls, and if we sell the 27 calls to open, so we're opening 2 different trades here to create a spread, you guys. This is how we can really fight decaying options. This is so cool. We're selling one and buying one to open, and this is called a call debit spread, which we use the symbol CDS in the Java Pit trading room, or some people call it a bull call spread. Okay, so we're buying to open, BTO, you'll see us put that a lot of times, 26 calls, and sell to open, STO, the 27 calls. So this is still a bullish trade, except we're fighting the gravitational decay. And guess what? These only cost us $28. Yeah, less than those options by themselves. And our maximum profit is $72. And we can make the maximum profit if on June 18th, silver closes, $27 and higher. But we're not going to ever do that. No, we're not going to go for the maximum profit. I like to get out of these as soon as possible. Timing is everything with options. I think you guys are learning that, right? Our timing has to be good. So, how do we get really good at trading and timing? Well, I'm going to let you in on a little secret, you guys. Most people that go into trading never learn how to trade the underlying asset, the stock. They don't. They don't have money to trade stock. They don't have a big enough account. to trade stocks. So they go, well, let's see options, right? These are cheap. I can buy these for $28. And it sounds great, but traders lose money because they don't know when to enter and when to exit their trade. Yeah, and I know many of you listening are probably in that boat. So what I do is, I've been a stock trader for really, 27 years, although I mostly trade options the last 6 years. But I learned and mastered stock trading, and not just any stock trading, day trading. And I know some of you might think that's a dirty word. It is not. It's the best thing in the entire world that I teach my traders, is how to day trade for many reasons, okay? Number one, it is going to help your reflexes. Yeah, entering and exiting, knowing exactly where a stock is going to move in a short time frame is going to really, really take your options to the next level. It's really important to learn how to map these trades out and execute them. I can map them out, but if you don't learn, okay, how to execute with confidence, trusting, discipline, getting stopped out, you're going to lose in this game. So what I do is I do an options boot camp. It's a one-day class. It's an all-day live trading class. And the first thing I do is I teach my traders how to map out trades and how to day trade. And I'm going to show you a little excerpt from this past class. I did it 2 weeks ago. In the morning we do day trading, and in the afternoon we do swing trading, and I was teaching them how to do the credit spread. So I'm going to show you both of them. So here's a little clip. And again, I can't teach them everything in one day. I do a 2 week, which is 70 hours, but I kind of do a crash course in just one day. And I'm sure some of you were actually in this class, so this will ring a bell. So we had really amazing day trades the morning of the class. I'm going to be showing you how we mapped out AMC. Have you guys seen AMC? Oh yeah, this thing has been on my whisper list every single morning. So the first, you're going to see me showing the traders how to map it out, and then you're going to see me getting them in and coaching them and exiting. All right, here we go. AMC. So bullish above 11. You can see we've hit 11 a couple times, right? Major price level. There's a lot of room to go up. Target's going to be 1120 and 1136 and 1150, right? That was where R3, it's at 53, but I'm just going to put 1150. 1101, we're in. Calls in. And put your stop at 94 cents. Okay, 94 cents. So buy AMC 1101, stop at 94 cents. We're getting, see, now we're at 940. Just because I say 940 you can trade doesn't mean that at 940, you know, that's going to be when you got to enter. Don't do that. But I'm just saying. So our first target is 1120 on it. It's coming quick. So go ahead and grab half at 1120. Another quarter at 1136. That's your next one after that. Right there, we hit it. Come on, take some profits, some. It's going fast, but just take some around this level. Good job. Excellent. Not all of it. We don't want to have exititis. Half. All right, 1136. Take another quarter, and then another quarter at about 1150, like 49 cents. I like to get out. All right. We also mapped out a trade on FCX pre-market. Let me show you that one. We're going to be bullish above 42.55, 42.75, 42.96, 43.18, 43.24. All right, so FCX pulled back. Can we jump in at 43? Yes, we can. Let's go. We're in. We're gonna put our stop. This is a little bit wilder and crazier though, and this is how you're gonna discover which ones you like. The 43.18 is resistance. Oh, we did that already. You know what? That trade, remember I pointed that out? Okay, we're going again. But I would take profit. It happened while we were doing AMC. Unfortunately, a lot of the trades happen at one time, but it's still good. It's just kind of the second test. All right, so 43, 24 is person's pivots. So I want you to take some profit now at 43, 20, you know, 18 to 20 to 24 area. That was a quick one. There we go. And the next quarter, 43, 39 is the next, that's the Camarillo. I'm going to blow this up so you can see that right here. There's 43.39. That's a next resistance. Or you're going to stop out even at 43 or 42.99. But yes, to see how it's stuck. And what I want you to observe is the price action when we hit these pivots. Does it stop? This is how I trusted them. A lot of you probably never traded with them or trusted them. But you can see that we came right up to this Camarillo, pulled back. So it's second test. Go ahead and take some more profit at 30. It's coming up. 39 area. Yeah, it's going to hit that Camarillo. All right, pretty close. Came to 36. Why did it stop at 36? That's 3/8, by the way. We're still trading in fractions. Remember I told you that before? That's why I said to take some, take some profit in that area. So when I first started, I'm just gonna put this over here. The market was trading in fractions. Yeah, excellent job. This is a good day. All right, so now you can see why the day trading is just so important for the skill set. But in the afternoon, we searched for swing trades using the recent dark pool prints, and a lot of you are going to know these prints because they've been in the dark pool insights. So I pulled up the prints for Oracle, right? Remember Oracle, this big print, 1.6 million at $76.60. So check out this daily chart. Yep, we closed strong just above that 8 EMA, ready to rip. Right, that looks right to go. There's no resistance above. I really love this trade. So we put on a call debit spread, a CDS. We bought the 79.50 calls and we sold to open the 80 calls. Yeah, I'm gonna show you the video of us mapping this out and getting in the class on Oracle. Take a listen. This is good. 79.50, 80. Risking 13 bucks to make 37. Yeah, as long as it goes up to that, 79.50, 80, the sky is clear there. I like that. I like this trade. Okay, so over the next 2 days, Oracle continued to move up, but my day trading skills kicked in. I spotted selling at $79.50 right as it got up there. So I took some profits and I called it out in the Java Pit trading room. There you go on May 17th. I always type all my trades out in the alert tab. I got out of Oracle half. I like to scale out of the call debit spread, 21 cents. I paid 14, so making 50% ROI at the May 21st expiration. And then I got out of my last half when I saw that it could not break above that 50 level. Here's the chat in the trading room. Patty B followed me into this trade. She got out at 22 cents. And I always like to write the reason so my traders know why I'm entering or exiting. And I wrote, I'm not crazy about the price action. They kept selling at 50 cents. They were refreshing and I didn't like it. So I got out, and you can see that Oracle moved down. Yeah, they were indeed selling. And here's the spread trade. You can see, right, 21 cents it went up to. Again, we don't need to make the maximum profit. It's really important to follow the stock and what the stock is doing and use options as a vehicle. Now, the coolest thing we have in the trading room is when I do a trade, I put in the alert tab, it makes a cha-ching sound, but it also pops up on your screen. See, I actually was able to take a picture of it. As I posted it, I was snapping a picture of the option chain to show you guys. And yeah, and there it popped up. Okay, are you guys ready for the next one? Yeah, let's move on to a credit spread. Yeah, a credit spread. This is a put credit spread. It's different than a debit spread. Yeah, a credit spread. This takes advantage of option decay. Yeah, this is completely the opposite. You actually want to hold these trades till expiration. You're selling the options, except you're not naked. Okay, I know a lot of people will warn you about that. Do not. You just sell options without owning the option, but this is different. Okay, because I know a lot of times you watch your options decay, but what if you could make money on that? Right? Being on the other side of that trade. So this is incredible. I'm going to show you an example. This is a bullish one, okay? Put credit spreads. So remember that big print on PG? That 1.7 million we got on April 30th at 132.84? Well, I really like the setup. We had moved up, we pulled back to the 8 EMA, and now we were ready to go higher. So take a listen from the bootcamp class when we put on this PG spread trade.
So this is a pretty high POP, P50. We discussed that in the options class, which is good. Just a high probability of the trade working out. This would collect a credit of 40 cents. The buying the 137 puts and selling the 138s, as long as it closes near that 138 level. So it could go down a bit, but again, this looks really good by next week. We have a lot of things working in our favor.
So the object of this trade is we take in the 41 cent credit. Okay, we're taking that money in, and if PG could close at 138 or higher at the time of expiration on May 21st, we get to keep it all pretty much. We try to get it down to zero. We actually want the price of these options to decrease because we're taking the money in first. It's completely different. So look what happened on PG. This was not easy. It went up and I got excited, and then it went down and I was not excited, and then it went up again and I got excited, and my gosh, I wanted to throw up. I'm like, get me out of this trade as fast as I can. Because here's the deal. It's like you need a crystal ball, right? It can drive you a little crazy when you have to hold something to expiration and you're watching it go up and down, and it's not good for you to get out because the decay hasn't happened fully. We're making money on the decay. So this had only 1 day left before expiration. What do, you guys? You have a profit, but you don't have the full potential profit. Do you get out the day before with a small profit? Oh, I did. I couldn't take it anymore. So I got out with almost 50% profit. Here's the spread trade, went down to 19 cents. I did get out and scaled out of half, making sure I had a profit of 10 cents. And then I got another quarter at 20 cents. And see, look at this. And then I got out of the last quarter. Yeah, it worked out, but it was all over the place. Yeah, these are really hard for me personally. It doesn't fit my trading strategy. Again, I'm a more aggressive trader. I like to get out into strength. And I don't want to, what if on Thursday your trade looks great and then on Friday news comes out overnight and all of a sudden you had this great profit and then it disappeared. So again, I prefer the debit spreads. For example, check out this put debit spread. Yeah, here's the chart of it. This is a bearish spread, okay? And with these spreads, just want to let you guys know also there's limited profit, which is okay. We can do really well. Can make 50 to 100%. But there's a limited loss, and I love that. That's what I love. It's all about risk when it comes to trading. And the way that I like to put them on is really cheap. So I'm going to show you an example of a put debit spread on the SPY. I love the SPY options, by the way, because they have the most volume at every level. Yeah, they're so voluminous. It's a penny spread. They're amazing. The weekly, they have Monday, Wednesday, Friday. 3 expirations in 1 week. Yeah, it's very rare. The SPY has that and the most volume. But of course, you have to know when to enter. That's the key. So check out this bearish engulfing candle. You guys, that looks ominous. That is bearish. So when we closed that night, I had to put on a protective trade. I bought a SPY 414, 415 put debit spread for May 21st at 25 cents. This is what it looks like. You buy the 415 puts and you sell the 415 puts. And these were 25 cents I got filled. These are the puts. So risking 24 bucks around that to make a maximum profit of 76, right? You guys would take this trade. I know you would. This is amazing. The next day, we gapped down. Now, we were below massive prints, by the way. And I put at 6:40 in the morning when we gapped down pre-market, I wrote in the trading room, SPY's below massive prints right now. And protection is highly recommended, all right, in my trading room. The dark pool was selling. Now, for those of you that don't know what it looks like when there's sell prints, I'm just going to show you a little example. So on May 11th, we were getting these prints, 502,000, right? That's the signature share size. If you have my book, I talk all about this. These are what we call them, the Levi's. But look at the price of those trades, $417.83. But wait a second, the SPY was not trading at 417. It was trading at 412 and 413 and 414, $4 bucks below. These were done the day before and they didn't show us until the next day. When I see this, we turn bearish, especially when the levels are high. So they were selling right there and not showing us until the next day. But we were below heavy levels. I'm not showing you that right now, but we were below a lot of them. I had the confirmation that I needed. You know, they sell, they take it higher. They sell, they take it higher. But as soon as we go below major levels, and you guys know because I point this out every week in the Dark Pool Insights, I show you those levels. Yep. But, you know, it's all how you want to trade. So I really prefer doing these spreads. And I like to roll them. So you see I got out of half of those 40 cents. I paid 25 for them. I got a last half 40 cents and I will roll if it rallies up. And then I rolled 6 minutes later. It didn't rally up. I rolled to the 410, 409 put debit spread. Same expiration, May 21st, and this was May 11th, you guys, so we had some time on these. And these cost 28 cents. So I sold one for 40 cents and bought cheaper ones, and I always do less contracts when I roll, so I can't lose everything I made on the last trade. It's another little secret. Then I got out of half of those at 40 cents. The last half at 39 will roll soon. I rolled. I bought the 404, 405 put debit spread for 25 cents. And this time I went closer in time to May 19th. And I rolled to the 521, 410, 411. I bought some other puts, 408, 407. I got out of the 410, 411 puts, 30 cents. I rolled, I got out, you see what's happening, right? I do this all day long. But not every trade works out, you guys. Nope, I'm gonna show you a trade that did not work out. And this is a credit call spread. Okay, a call credit spread. It's a bearish trade. Even though we're using calls, right? It's a bearish trade. We're collecting a credit. So remember, those are the trades that we collect the money first, and we want those option prices to decay and go to zero. So check out this chart on American Airlines. This looked uber bearish. Okay, this looked like it was going to crash down. Pun intended there. Now, American Airlines, we had this big print, $20.81. I was watching this for days, and it just looked so good. But again, not every trade works out. So I put on this call credit spread, bearish trade. I bought to open the 2150 calls, and I sold to open the 2050 calls, taking in a credit for 60 cents. However, it didn't go as I planned. Not a big deal. I could lose 40 cents on this trade. Okay, that was my risk. But look at this. It did not go down. It went down a little bit. I got excited, but then it went up. And then it went down a little bit. Then it went up. And then it went down a little bit. This thing drove me crazy. All right, yeah, it was not good. I thought I was running out of time. So I took a small loss of 12 cents, and then I rolled with more time, but I still lost on the trade. It's not a big deal. No, it was a good, you know what? I would do it again. It looked amazing. The reason I'm just not a fan of these credit spreads is that you have to wait until the expiration. Like, I would have gotten out aggressively on the down move, but I knew I had to wait it out until expiration to receive, the maximum profits. To get a decent profit, we need the options to decay. And when there's time left, they're not decaying as rapidly as we want, right? So, that's just my strategy. We all trade different, and options have options. There's so many options. I've taught you a couple of them today, but obviously not all of them. Yeah, but it is great to learn what your options are, which is why we teach a 2-week all live options bootcamp. All you have to do is go to thedarkpools.com and visit our store. Go into the live classes section, and you'll see it at the bottom. You'll see the 2-week options bootcamp. We actually have it separated. The first week is beginner. That's where you learn all the Greeks. And the second week, we have a week off. The second week is really intermediate, advanced strategies. Yeah, just unbelievable. We trade a lot of stuff into earnings as well at that time, and it's all live. It's all live options trading. The next one is coming up in July. It's recorded just in case you can't make it live, but it is always better to attend live because, to be honest, you want to take these trades. Oh yeah, these trades are amazing trades, all in real time. So I hope you guys learned a little bit today about the different kinds of spread trades that you can put on and how to trade around the dark pool. That is the most important thing. We don't take trades if we don't have the dark pool. So until next time, happy trading, everybody.
No thinking, that's my secret. Gonna keep it my secret.